Welcome back to Switzer on Sky News Money. Now, reporting season always unearths stocks that we really wish we'd invested in before the profit report show and tell kicked off. To get in advance, I've commissioned Rudy Philippek Van Dyke of FNArena to give us 3 stocks that he thinks will salute the judge when it comes to the big reporting days ahead. Rudy, thanks for coming on the show.
Well, the pressure's on.
Yeah. Well, you know, you don't come on this show unless there's a bit of pressure. There's no point having you without pressure.
Okay.
Okay.
I hope I can withstand pressure.
Okay, the pressure comes when reporting days come and we see how good your calls were. So let's kick off with the first one you like right now.
Well, let's divide the reporting season in 3 sectors.
Okay.
Right. The obvious one, and I heard Shane giving a short summary, and he's absolutely spot on this one. This reporting season, at face value, will be one of the best Australia has seen in many, many years. Unfortunately, that's not the whole story, because in a certain sense, the reports that will be issued in August are actually old news. I mean, actually yesterday's financial year. So it will be more about the outlook. And the outlook is questionable consumer spending, higher costs, and now all of a sudden a high dollar. So they will weigh upon outlooks, I believe. So it is well possible, and we also have no longer the wind in the sails for commodity prices. It is well possible we will have a very cautious corporate Australia giving outlooks for FY18. Yep. And that might well, we have to see, but we actually need a little bit more profits past FY17, because that's going to be fantastic, but it's all resources. So sector number 1 to nominate in August is the resources sector. And then predominantly the miners, not so much the energy producers. And what's going to happen there? These guys have so much cash, they don't know what to do with cash. There's a whole debate going on in the background now about whether those in charge of resources companies, whether they are changing their ways, whether the leopard actually is changing its color. And as a result of that, and let's assume that the answer was positive, as a result of that, resources companies, in particular miners, will give a lot of cash to shareholders, starting in August. So what we will see is buybacks, special dividends, maiden dividends, increased dividends, you name it. And of course, the candidate number 1 would be Rio Tinto. But people might be surprised as well that when we do a little bit of a search on dividend yields in the Australian share market at FNArena, one of the top dividend payers now in the share market is Fortescue Metals. And Fortescue Metals, that's obviously because the share price is relatively low, the cash levels are very high, and if current forecasts, they tend to be accurate this close to the reporting season. If current forecasts are correct, Fortescue Metals is going to be paying out one of the highest yields in the share market right now.
So this is your
higher than Telstra.
This is your first Rudy Philippek Van Dyke destroyer for ahead of reporting season. FMG.
You know, a lot of investors will always go like, "Oh, you never buy resources stocks for their dividends,"
No,
but a lot of investors will enjoy the spoils in August. The likes of Zimbabwe gold miners, they might actually start paying a dividend. The likes of South 32 simply have too much cash. That might also be the case for Whitehaven coal, by the way. And the list goes on. In particular, a lot of the gold miners will pay out a lot, I think.
But the one you're really putting your hard-earned money on is FMG.
Yes.
Fortescue.
Yes. With the caveat, of course, that that's a short-term thing. Forecasts for FY18 are a lot less, and maybe not necessarily immediately so, but it's all dependent on the iron ore price, right? And that's still suspected that it will be lower next year than this is right now.
Okay, let's go to your second one, mate.
Then we get a second category. That's the one I like. I mean, we have some prime quality growth stories in the Australian share market. Unfortunately, they're not trading on single number PEs, and every reporting season, there's always 1 or 2 that miss, and they always get a lot of attention, and people go like, "See, you shouldn't buy expensive." I'm actually of the other view. I look at the other ones, and the majority of those stocks actually comes out with good results, and a year later, the share price is a lot higher. The ones I have a suspicion of that will, the combination of momentum in late fiscal 17 and moving into fiscal 18, probably on the positive side, I would nominate REA Group, I would nominate car sales, and I also have a suspicion that contrary to what some people are thinking and contrary to past practices, that CSL is going to surprise as well to the upside.
CSL?
Yes. And so, there's another element also what happens is that people at this point in time, they look at PE ratios of fiscal 17. If you look at companies like REA, CSL, car sales, corporate travel, Aristocrat, Seek, yeah, those PE ratios look really, really high. Now, you're deluding yourself if you sell those stocks because of that, because those stocks are actually trading on fiscal 18 PEs, if not fiscal 19. And if those growth numbers come through, the PE ratios are a lot lower than what they seem on FY17 numbers.
Yeah, good point. All right, the final one. The
final one, of course, the beaten down ones. And there's every reporting season, and admittedly, they are often beaten down on sector-wide selling, and then obviously they have a chance to outperform to the upside. In particular, if there's a lot of short sellers around. Now, that's not really my game, because I usually don't like speculating on stocks that have a very bad past, and then you sort of speculate that the turnaround comes. And
you're the all-weather guy.
Exactly. And you know what Warren Buffett says? He said a lot of those turnaround stories, they never actually turn around. Huh? Yeah. That's the problem. But for instance, I own Bapcor shares, and I couldn't help but noticing this week already they came out with good news. Good news. I have
an Asian movement, isn't it?
Also, but also they get more synergies out of their acquisitions in on the other side of the Tasman, yes. And I have a suspicion that they're going to come out with a good result in August, and they might have started a good news cycle here. So I would definitely nominate them, and I would nominate a stock that is a little bit in the margin that nobody pays attention to. And they're called Here, There and Everywhere. and for the fans out there of Beatles, yes, it is a Beatles song, by the way. Right. And, but nobody pays attention to them. And
what do they do, mate? Here, There and Everywhere. Sounds like a travel company.
Well, if I tell you that this is the old APN News and Media,
oh, really?
You know exactly what they do. Right? Yeah. And since the name change, they're sort of in the shadows of the share market. And radio has done relatively tough the first half of the year. But these guys, what a lot of people underestimate, these guys are an outdoor media. And people always pay attention to APN Outdoor and O Media and QMS. But HT&E, HT1, they're also in that sector. And the share price is gradually picking up a little bit, and I believe that they might surprise as well, because expectations are so low. Now, in the tech space, there are a few companies where analysts are tipping upside surprises. One of them is Appen, APX company code, and the other one is Integrated Research, IRI. The difference between the two is that Appen is already looking like this on the price chart, so people are definitely anticipating a good result. But Integrated Research is a little bit going sideways, so they still have, I think, potential to surprise to the upside.
Mate, look, I can listen to you all day, Rudy.
And did I stop at 3 or what?
Yeah, you over-delivered as always. Mate, thanks for coming on the show.
My pleasure, Peter.
Rudy Philippek van Dijk of FNArena. Now,